Well, in his latest India equity strategy report, Sanjay Mookim of JP Morgan actually speaks about the earnings season gone by. He speaks about how a lot of the companies have actually enjoyed strong margins and strong margin expansion. He also cautions about how some of these gains may not sustain going forward. Now, what he is saying is that lower costs as well as resources that companies actually reported in the quarter gone by is something that actually saved the Indian second quarter earnings season. However, what he states is that the elevated margins is something that may not sustain. He's saying that the lower costs have been a significant support as far as aggregate Indian earnings is concerned. He's saying that the EBITDA growth for 445 companies in the BSE All Cap Index, is barring the resources companies, was 4.6% in September, but however it would have been a negative 1.6% if employee costs as well as other expenses had remained flat. Now what he is also stating is that wages have actually grown at their slowest pace in several quarters, while other expenses have actually fallen quite meaningfully. Now what he is saying, going forward, companies might be able to retain some changes in terms of enjoying less travel expenses and going and adopting more online interaction techniques. Now what he is saying, however, is that hope of economic recovery also implies increased competition, and this is something that will actually erode margin gains. It also, given the fact that margin gains will be eroded, it proves to be a potential headwind as far as earnings are concerned. Now what he is saying is that the headline second quarter FY21 EBITDA growth for the broader set or the broader market is almost at 12%, and he calls this a stunning 12% year on year. But however, he states that this is on account of large telecom losses last year, and again he's saying that strengthened resources companies, some of which are inventory gains, have actually aided earnings. So he said that if you take off the telecom losses last year, and if you also adjust for the inventory gains that some of the resources companies have enjoyed this year, he states that the EBITDA growth is a more modest 5% on a year-on-year basis. Now he's saying Indian results are likely to reflect the shock from the lockdowns for a few more quarters, and he believes that earnings going forward could remain quite volatile. Now what he is saying is that the key risk is to consumer discretionary companies, where expectations being built in are very high, and the sustainability of demand trends, he believes, is quite suspect. At this point of time, he is actually overweight banks as well as IT, while on the other hand he is underweight discretionary stocks. He also states that in terms of going forward, aggregate profits on accounts of resources companies are something that, if you're talking about in the quarter gone by, led by inventory gains, is something that again may not sustain going forward. So overall, a cautious note being struck by Sanjay Mookim.